scenario, since we're looking at down payment assistance. So I'm going with a purchase price of 600, a 3.5% down payment, so FHA style. The loan amount's 579. I'm going to use 600 as our credit score. I'm going to leave the income because it doesn't matter so much. I do have this marked as first-time home buyer. Let's see what happens. So down payment assistance is pretty cool. Probably the biggest hype that we saw with getting this topic in more of the mainstream was the Dream for All program last year. I had 7 people, 7 pre-qualified for that program. And in the 10 days that it was actually available, where you had to submit a accepted offer with your pre-approval, I was able to get one of those people into contract and that loan closed. Those people also ended up in a house that was essentially 150 grand more than their income would allow based on that program, because it was a huge 20% silent second, which allows them to borrow almost take $120,000 and use some of it for their closing costs. They got a $600,000 house, 0% out of pocket. I actually believe they might have got a portion of their EMD money back, if I remember right. It was like maybe $1,700. So essentially, they almost got this thing 0 out of pocket. Now, when they sell, yes, they will have to pay off that 120 grand like any other 100% loan. It just happens to be split in 2, and they will have to then give a percentage, which for them is 20% of the profit. So if the home goes up in value 100 grand, they would end up giving away 20% to the program, CalHFA program. But they got to live in a house that they could never have afforded. They got the equity growth of a house that was 200 grand more than they could afford. And they're only paying that money back if they sell or refinance. Other than that, and they got a smoking rate, because actually CalHFA rates are pretty darn good. And I'll show you right now. So that program was great. That got us excited. We were super excited. I had a whole marketing plan based on that, but the timing was gone. It lasted, I think, 10 days. It was crazy. But let's talk about this borrower. So buying a house at 600 grand, 3% down, decent credit. I actually went down in credit because this is the minimum, the average minimum for most DPA loans, 600. Let's see what our offers are. We're going to only worry about, well, we'll show VA. So 6.7, that's great. This is also, that's not too bad. Coming in here, conventional 30, 7.4. And where's our FHA? Right here. So 6.7. So these are right in range of where we are. Not a huge change with a very low credit payment or credit score, which I'm interested to see. Let's look. Let's see if that changes. Let's go and see what happens to these rates with a client that has great credit. Let's see what happens. And then we'll jump into this exciting program. Let's see, Travis, as we go through this, it might be helpful if you stop me, like jump around or something. Yeah. So I catch you, like just, and then I'll stop and you can check chat or something if anything comes up.
Yeah, definitely, guys. If you have questions along the way, throw it in the chat and we'll get those answered as well.
Look at this. This is, man.
It's because it's so cold out this morning. And the
it is cold. You are correct. So let's look. So boom, how interesting is this? Our FHA didn't change much, 6.7. Our conventional conforming, 7.3. Actually did go down a little bit.
Just a touch.
Not significant.
No.
And where is our... Why did we lose? What? It's my computer's still like not happy. Oh, VA was here. Okay, so that was 6.7. VA, FHA is 6.7. So the rate change, the credit score didn't change a whole lot for this. And I think where else, the other place where we saw this, not credit score not being as a major player, was when rates were in the low threes and twos, 600 or 800, you were still getting a 2 or 3. It didn't matter. And I think what we're seeing right here is UWM realizing, you know what? Because rates are already close to 8%, we can't just ding a 600 credit score guy. We've got to take a little bit extra risk on our own part, which means they might not be changing the rate as much. And that's one thing that happens with all these companies. They have the ability to sort of fluctuate their own, risk levels within their own program. So, but rates look okay. They are where at. Here's one thing. We always talk about borrower paid or lender paid. Lender paid is obviously cheaper to the borrower because it's built into the rate. But we currently, with these rates, very few people are quoting lender paid, as well as what's most the ideal rate to quote is if you're quoting a par rate using lender paid commission, which is a legitimate like zero cost to get the offered rate. And that works at zero. If you spent some money, you could buy down your rate. And if you needed a credit somehow, you could potentially go to a slightly higher rate, which would then rebate money back to help you with closing costs. So, but most people are quoting borrower paid right now and charging an origination fee because it lowers the rate shock and it's much more palatable. And I think a lot of lenders like us are potentially taking a haircut on how much they're earning on these deals because it's just a challenge. So, all right. Any questions on rates, anything like that I haven't seen yet? I don't see anything in the chat. All right, let's get into this. Boom. Okay. Down payment assistance, also known commonly as a first-time home buyer program. Not all down payment assistance programs require you to be a first-time home buyer. Let's call it the industry requirement for being a first-time home buyer means that either the single or anybody that's on the loan would not have held title to a property in at least the last 3 years. So if you're buying, if you sold your house in 2019 and you bought today, you could qualify as a first-time home buyer. Now, there's a lot of talk about first-time home buyers and programs for them. Most of them are just marketing. The down payment assistance, when they are limited to first-time home buyer, could be the only real legitimate program that a first-time home buyer could get. And essentially what this is allowing is a homeowner to essentially buy their home at 100%. There's a couple things with these down payment assistance that they can do. So the most common down payment assistance are basically 3% for if the loan is based off of conventional, 3% down payment is the lowest they require, and 3.5% for FHA. The most common programs to date are based off of FHA for that. And there's a couple reasons why their FHA is a little bit more common. Some of the requirements are a little bit more favorable to a borrower because this is a government-backed loan, and it does allow that extra 0.5% towards the down payment. Additionally, there are some DPA programs that have a additional component that allows a silent third to also be borrowed at the time of purchase, which allows you to cover some closing costs as well. So while the general format is either 3 or 3.5% based on the required down payment, there are a couple of options within the family of these programs that does have a silent third, and it's always seems to be 2%. I've never seen anything different. Oh man. So, all right, boom. So FICO score. This is if you're talking with someone and they're interested in this, this is in any scenario, this is the number one thing, because this is the do or die number. Most of these DPA programs are going to require a 600 credit score. They want to help by giving you this extra loan and trusting this person that's a first-time home buyer with 100% purchase, but they want to know that you have a good repayment history for the debt that you have in place. There are some that go down to 580. Some of these ones, very few of them that are FHA will also go down to 580. There are a few that have a much higher requirement, up to 700. In general, 600 is that number you want to hear. That is, check that box. Let's keep moving forward. I think I can help you. All right. So income limits. This is a very interesting thing. So in general, when you're talking with, a new prospective buyer, you might ask what their income is to get an idea how much they make. These down payment assistance, they are meant to be, they're designed to help, not necessarily, I guess you would say, lower income or limited income. And so AMI is a term, area median income, and it's different for all the different counties. And so what these programs are based on, where the property is located that you're purchasing, that's the AMI that is important. And these range anywhere from 120 to 160% of AMI. So if the AMI, say for, I don't know, this 87, let's say I'll use Riverside County for some reason, because I feel like that's maybe accurate. If the AMI was there, a borrower wanting to use a down payment assistance program could earn up to 104K, which is 120% of AMI. A different program, let's say they made, instead of 120, let's say the guy makes 115 grand. Now we need to find a program that has a higher AMI, which I know they go up to anywhere from 120 to 160. There are a few, very few, that have no limit to the AMI. And we found this to be a major problem back, I don't know, I would say 2020, maybe 2021, early 21, we were trying to qualify a lot of people in some of the lower income areas. And what had happened was these lower income areas, they have a set AMI, except COVID hit. Everyone was offering 100, 200 grand over list value. And all of a sudden houses were way higher. And these AMI limits were people were qualifying for, like say guys making 140 grand, he couldn't buy a home and use this down payment assistance program because the homes in the area had gone up in value so fast because people were just throwing money at properties. So a particular program in that scenario a no limit income might be helpful. There could be, and when you, as I go through these and I point out some of the differences, the challenge that we always run into, and it's more, it's a harder stop. It's not any harder stop, but it seems, it feels more negative when we're talking about DPA because of limitations. And there tends to be more, but there are limitations in every type of loan. And so what we do is we want to try, if you don't fit the mold of the ideal loan or DPA program, we want to shift it. And let's say we had to go from a DPA program that had 120 AMI, they also could have a slightly better rate. They could have, the rate could change. The qualification of somewhere else could change. The DTI requirement might differ. A program that has no income limit might have some other penalty that is noticeable within the loan. But we want to, the goal of all these programs and down payment assistance isn't to get a lower income person into a house. It's to solve the problem of the down payment. Because a lot of borrowers have 10, 15, 20 grand, but they don't have 40 grand to cover closing costs and down payment. So it is important to realize that there are different programs. And as we work through these, we might have to shift programs. And that can be a challenge, especially if you're not fluent in these programs. So,
and that's why we, when you call us and we're like, hey, what do they qualify for? It could be so many different things because we have to look at their income
absolutely.
and where that's falling, and then their credit score, and then the price of the home, median area income, like all these different things come into play. And
Yep.
so we can say, okay, they're not qualified for this one, but they are qualified for this one. And so it kind of dwindles it down a little bit. But there are a lot of options. I mean, if you look at the area median income, that's a pretty average income, I think, well, obviously it's a median income for the area. So it's really, in my opinion, not that hard to qualify for these. It's just, yeah, what you said about the negative connotation. It's not really that. It's just a different loan program to help cover down payment, really.
Yeah. And I'm going to hit on something else in just a one or two slides ahead that seems like a big deal here. But it can be part of a traditional loan. But so DTI requirements, most of the current programs, actually, I'll pause for a second. So I have CalHFA listed as second. CalHFA is probably the most well-known, at least in California, and most states have a HFA program that sort of mimics the CalHFA. But this is probably the program that's been around forever. It's also the one that used to be that was probably some of the original, like police loans and nurse loans, teacher loans. They were all really based on this CalHFA loan program with a DPA or some type of a credit break or something. And if you remember way back in the days, if you've been around for a while, these CalHFAs were in these kind of, let's say, first responder type loans or teacher loans. They all had this education piece with them, and that came from CalHFA. But and a lot of sadly, a lot of the negative connotations about DPA programs are based on, CalHFA when they came up with these programs 20 years ago. Everything has changed, including how a CalHFA loan works and functions and everything else along with it. So, all those problems are essentially solved. But most of the programs that I see and I like are based on FHA loans because they tend to have a little bit more generous or a little bit easier requirements for the buyer. So for instance, you can see 47 to DTI. So this is front end. This is essentially 47% of your income can be your mortgage. As long as your total debt, outgoing debt, is 57% or less. So that's when you see a front and back end like that, that's what that means. CalHFA uses a flat 50%. They're just a little bit more strict, where this is one of the more relaxed FHA guidelines. In a traditional FHA guideline, if you're putting down the 7%, you might be able to get the lender might go to 57%. They might not. It might require a manual underwrite. And it also could require a slightly higher than 3.5% down payment. So this is a benefit that we look at. And sometimes it comes in handy. I mean, it could be the difference between 50 and 57% at, it could be a car payment potentially that allows this to happen. But so they're not extra strict is probably the most important thing to take away from this. These are pretty traditional DTI requirements. So for a down payment assistance first time buyer program, your borrower purchaser is not getting hit harder. Their limits are not higher. Payment shock, this is what I was talking about, and kind of what Travis was talking about. So a lot of loans have payment shock. This is a key item for a DPA loan, especially some of the newer ones. But here's the thing: another program that this always comes up, if you use have ever had buyers use USDA loans, they have part of their biggest thing is the payment shock to qualify. So if your borrower is currently paying $200 or $2,200 in rent, and the program that we want to use had a payment shock maxed out at 175%, the most their mortgage payment could be, regardless of what the DTI is $3,850. So now this particular item, when we do the math, supersedes the DTI. Let's say, for instance, the DTI, they were doing the FHA loan. The DTI was, let's say it was 48% for everything. But their mortgage payment, let's say they were living with their mom. That might be a bad thing. That's something to kind of put into play. Oh, where are you living? With my mom. Okay. You want to use a DPA program? There could be a payment shock. From 0 to anything is more than 175%. So that can be an issue. But I mean, if you look at these 4,900, 225%, it's not, there's a limit, but it's not horrible. And this is a pretty big gap. Now, this is also payment shock is being talked about a lot right now because of the high prices of homes and the 8% rates. Right now, you're probably seeing this in your feed. Renting is significantly cheaper than purchasing. And we looked at this, one of my realtor buddies and I were talking about this last week. He rents a property that we believe would probably be $900 to $1 million if it was put on the market today. He pays $3,000 for that in rent, and he's been there for a long time, so he's getting a good deal. They don't raise his rent very often or very much. He also does a lot of the services and maintenance himself. But to buy $1 million house in that neighborhood using, let's say, 5% down, we looked at it, that payment would probably be about $8,000. That's 220% above his current rent. Simply, it's $5,000 that he has to come up with just to live there if he wanted to buy it. Like, nothing in his life changes except he's the owner. So now, the whole idea of, we used to we've marketed the idea of, especially back in COVID, why rent when you can get a house with 3% mortgage, that's going to be the same or lower. Right now it's double. So that payment shock like this affects this loan quality, but this idea right now can scare off buyers and put them on the sideline. My feeling on this topic is if they're serious, you've got to talk with them about the long-term effects of owning a property, owning your own property, just the feeling of that, the accomplishment, the idea of your mortgage being a forced savings, the idea of owning property is helping you build equity, which in the long run is going to outweigh payments. But again, they have to have that money. But I think, in my opinion, the biggest fear that this idea of rent to ownership price shock is going to cause a lot of borrowers who actually can't afford a mortgage that's twice as much as their rent to pause and hope things get better. And a year, 2 years down the line, they're going to be, if they absolutely buy, they're going to buy a house that's much less than they could have bought today. They're going to have missed out on equity, and they will have wasted $50, $60, $100,000 in outgoing housing expense. So although the monthly payment is double right now, to keep it simple, there are still long-term benefits of buying. And so I think that conversation is really tricky right now, because it's hard. I mean, no one wants to pay more than they have to, but it's happening because of the way the market is. But you've got to, and I believe 100% that buying a house is 95% emotional, and about, let's say 3% need and 2% like financial logic. It comes in the financial logic or comes into play now and then throughout the process, but it's never the main reason. All right, DPA repayment. This is always an interesting thing, and it's not really talked about in general too much, but there's a lot of options for these different types of down payment assistance. So it's all based on the 3% or the 3.5% required down payment for a loan. Now, a little bit of understanding about a down payment. When we talk about closing costs, and if there's closing costs, well, there's three main financial pieces that come up at the end of a loan close to purchase, when you're signing your CD and escrow is kind of balancing everything out. And there's the cash to close, there's closing costs, and there's the down payment. Now, cash to close incorporates both of those, closing costs and down payment. But the two are separate. Here's one thing that a lot of people don't know is you can get, if your down payment was, let's say the down payment is $15,000. We'll say $25,000, and closing costs are $10,000. The cash to close on that would essentially be $35,000, 25 for down payment, 10,000 for closing costs. Your borrower could get a concession from the seller, a seller credit for $10,000, and cover the closing costs 100%. Let's say they get a seller credit for $15,000. In that scenario, they can actually pay the $10,000 towards the closing cost, so that's covered 100%. What a lot of people don't know is that extra $5,000 cannot be used as the down payment. The down payment has to come from the borrower from their bank account that's been sourced, and it's set up that way to prove that your borrower can afford this property and meet the requirements of the loan. So in that scenario, you want to look at what else can I do with this $5,000, because I don't want to give it back to the seller, and that would be the only option if you can't use it. But you could pay potential HOA fees if there's one. You could prepay PMI if they're buying it, say, under less than 20% down. You could buy down the rate. You could use that as a temporary buy down, which I never suggest, but you could buy down the rate in term. Even if that $5,000 only changed the rate by like 1/8%, it's still 1/8% for 30 years, and the savings will be there. But the more important piece in that, in my mind, is for your client as the realtor and the lender, you figured out how to maximize the credit as best as possible, because the borrower cannot get help from the seller to pay for the down payment. So little
If I
side
could
note there.
build on that a little bit. So heading into, what's typically the slower season, I would suggest, well, at any time, I would suggest getting the most current costs that the lender is going to be providing the buyer, and then seeing if you can work in a seller credit. I mean, I've seen a lot of buyers, and we had one, actually one of the agents is on the webinar right now, where they got into contract, they got quoted a rate, they got into contract, and now they just got their loan estimate sent to them. And there's an extra $12,000 in closing costs that they weren't expecting. And they're like, what is this? Why do I have $35,000 in closing costs? And it was because the lender had to put in a buy down, to buy down to the rate. I think to probably, this isn't one of our loans, so I'm not 100% sure, but probably there was a debt to income issue or something like that. A rate that they got quoted 2 months ago is not what it is now. And so they tacked in an extra 12 grand to get them to that same rate. And the buyer kind of freaked out and said, why is this so high? And it was literally $12,000 in buy down costs. So, if you're working with a lender, it doesn't even matter what lender you're working with. Our team, outside, doesn't matter. If you've been shopping for a while, have your buyer or you get the most up-to-date costs as you're putting in this offer, so if there's going to be a buy down or not. And if you have an opportunity to get a seller concession, there's not a lot of competition on the property, you're kind of negotiating on price, you might need to or want to put in that seller concession to help cover a buy down cost or potential buy down costs.
Yeah, for sure. And like that's a huge thing. Right now we're definitely going into the, let's say, market where concessions are more common, because a seller selling in this fourth quarter during holidays, they're motivated. If it's on the market, they are highly motivated, because there's no reason to try and sell a house in the middle of all this, because we're all busy during this time. Buyers at the same time tend to be more motivated, which doesn't mean prices are going to drop so much, but deals can be made. And that's probably the best way to talk with a buyer. We have a better chance of negotiating a credit, a potential lower price. We're not going to be able to you're not going to be like, oh, it's fourth quarter, we're going to lowball all our offers by 50 grand. That's not going to work. That never would. But you could come in at 97, 98%. You could ask for a seller concession in the offer. There's a lot more options for negotiating a deal. So back to DPA. So you see this forgivable silent second. When you hear the term silent second or silent third, what that means is whatever that amount is, let's say it's the 3.5% FHA down payment, is a silent second. What essentially has happened is they've removed that from the price of the property. and they've put that into a loan. Let's say it's 15 grand. And that they've essentially taken that loan and putting it up on a shelf to be paid when you either refinance or sell the property. If you never move and you pay off, you get to 30 years, 360 payments, you will then start paying your silent second. If you sell, you just have to pay that off just like any other loan there. But the benefit is with the silent second is you're now, all your math is worked off of, 3 or 5% lower than the purchase price. This is the key, which made that Dream for All program so amazing, was taking 20% of a purchase, taking as the example that I use, a $600,000 purchase price, 120 grand was taken out of that purchase price based on this program and set on a shelf to not be worried about until these people are in a situation to refinance, which would be they were financially capable to prosper if they refinance, or if they sold it in 5, 10, 15, 30 years. That's amazing. That's it. It seems like it's simple, but it's a massive benefit. You can have a silent second. Now, the first one I had here is the best one. It's forgivable. So it's a silent second, it's forgivable. This is typically what we would call a down payment assistance program that has a grant option. So if you live in this house for 36 months, sometimes it's 60 months, we see them the range anywhere from 3 to 5 years. Whatever that down payment assistance amount was, 10, 15, 18 grand, it will be waived 100%. The second is a silent second, as I described. It just sits at the back of the loan. It does not accrue interest the same way that that the mortgage does. It's there, just sitting there. And then a silent third, which I said a few of these programs offer, works the same way. It just sits at the end waiting. And then you have what's called a repayable second. A repayable second allows your borrower to qualify to purchase at 100% of the purchase price. So you get the first mortgage, that's 96.5%, and the second, which is the down payment assistance loan, at 3.5%. So they're buying at 100%. The repayable second, 99% of the programs charge a 2% rate hike for that loan. So if you're getting a 7, this repayable second is going to be 9%. Now that sounds crazy, but it is based on that only 3.5%, not 97%. So it's definitely not it's still better than the 3.5% being added into the whole mortgage. Now, what else is nice about this is we have a couple of programs options. So you could repay this second in 10 years. So starting the first 10 years of ownership, you could pay it back, or it could be the first 15 years of ownership, or you could pay it off all in one if you came into some money or something. But even the difference of that 5 years, which is 60 payments, can substantially lower that payment. Now, and I have not seen the 15-year term cost any more than the second. So in my mind, there would be no reason. Now I'd have to dive deep into those two programs and see if there's anything else that penalizes the borrower that makes it not make sense. But it could be as simple as, instead of a 600 DTI or 600 FICO, it might be 620. As long as they qualify, I would go to the 15-year because it's less money out of pocket. So that's how that works. Any loan in a traditional loan, all of the loan money is paid back at the time of a sale or at the time of a refinance. In the situation with the down payment assistance, people always, oh, what about this? Whatever they've borrowed whether it's 96.5, 3.5% to me 100, and let's say they got a third with that additional second, 102% of purchase price. When they sell or refinance, like every other loan, they're going to first pay back whatever money they borrowed before they start looking at their own profit from owning that house. Okay, so hope that makes sense, as simple as possible. Property types, this is pretty simple, but you know, single family, manufactured. With manufactured, they do expect it to be affixed to the ground, and they tend to require them to be at least a double wide. I think that has to do with the price or the cost of the whole property itself, but they tend to want that. If you have questions on manufactured or any type of double wide, mobile home stuff, reach out to Heather, join her you know, monthly group. She has done in the last couple of years, she has done so many of these, and she's really smart about understanding the small intricacies of selling a manufactured home on land, in a park, all of that. So and because of the prices of manufactured homes right now, there are a lot more people choosing those as options, because they can be, you know, they're sometimes as low as 40%, but there's, you know, even some of the nicer homes are still 60 to 70% of the typical price of the area. You can do condos, you can do multi-unit, which is probably, if you could get your borrower a 2-unit home using a DPI program, making income from the second unit, talk about a massive unicorn win. Like that would be incredible. I don't know if that's going to happen in California. It could, but you know, I think that would be an amazing thing. Even now, just considering what's going on, if you have talking with borrowers about 2-on-1s, 3-on-1s, 4-on-1s, which you can all sell, are good conversations to have right now, because it's quite possible that the property itself might not go up in value so much as when you look at it as the qualifications of acquiring it, as well as the potential for rental income coming in later and long term, meaning this might not be your forever property, you know. So those are things that could be more important to help people maximize their housing journey. All right, buyer education.
One quick thing on that.
Yes.
Is they have to occupy one of the units. So
correct.
You cannot use this for investment purposes. It would be awesome if you could, but you know, they have to live in one of the units as owner occupied. So
yeah, and I actually had that on one of my slides. Maybe I missed it, but so with these DPA programs specifically, a lot of the key things is probably the universal thing about DPA programs is there cannot be a non-occupying co-borrower. So if income is needed to purchase the property from 1, 2, or 3 people, all of those people on the loan have to plan to live in that property owner occupied. And so that's kind of what Travis is talking about a little bit here. So buyer education, these are simple 45-minute to an hour online webinar style classes. They go over, I've never sat through one. No one's complained about it too much, other than, oh my God, I have to take an hour to do this, and it's just boring. I figure take all of your CE training and fit like some highlights into an hour, and that's what these people are learning. But they're not expensive, $50 to $100. it is paid by the buyer. It's a requirement from the lenders to show that the borrower is serious about getting this loan and getting this property. So it is a requirement that they take part in that. And if there are 2 or 3 borrowers, only one of them is required to take the class. All right, the negatives, which everyone's always, wants to chip away at these things. Number 1, you do need decent credit, but decent credit is needed essentially for any loan. 600, 580, I've seen 580 this morning in my research. 600 is not that high of a requirement. Need decent income. Yeah, actually, you do need decent income to buy anything in California right now. With income, we have income limits, AMI 120, 140, and that's because these are designed to initially, this is where they say, oh, can anyone qualify? Because I've had people call me about DPA programs that want to buy $1 million properties. And, there are some that I could do that, but financially to get 3.3% of $1 million, call it 35 grand, to pay 2 or 3% higher in interest rate overall, just doesn't make sense anyways. But you do need a decent income, and you have to fit into that AMI requirement potentially. Number 3, this is probably the most important to understand. You still need cash to close. There are closing costs with down payment loans, just like every other loan. Closing costs tend to be a little bit higher, mainly because all down payment assistance programs are buyer paid commissions. So in today's market, I would say in the next year from now, these loan programs become potentially not a 1 or 2% higher, but 1 or 2% lower, because every other lender is pretty much quoting borrower paid commission pricing, meaning whatever the rate is of your high credit, high income buyer, they're still paying 1 or 2% in origination fees, just like a down payment assistance loan borrower is going to pay. So it essentially, it's better. This loan is a little bit better right now because of the way that everyone else is charging for loan products. But it can be a sticker shock. I ran into a lot of problems where, I think this is the biggest problem with down payment assistance, because it gets people excited. You mean I don't need a down payment? And they get focused on the down payment. And a lot of times the closing cost conversation gets missed, and you might even have been showing houses or something. But all of a sudden you're like, hey, like Travis said, imagine if you knew you had closing costs, but all of a sudden it showed up, you were expecting 12 grand and they said it was 2,100 or 21,000. You're like, oh my God, that's crazy. At least that buyer was expecting some type of closing cost. A lot of times these guys don't think there's anything, but there is the normal closing cost. It's separated exactly the same like every other loan you've done, except like I said, it does include a borrower paid commission. Some of these programs do have a add-on fee of some sort. It's usually like $500 to $700. It does show up in the LE. It's not as painful as 2% of purchase price, but it is in there now and then, depending on the program. And you probably, if you went through these programs, you probably couldn't figure out if there's a benefit to the buyer to pay that. But if they have everything else going for them, they're qualified. It gets them in the house. A $500, call it an admin fee or a junk fee, is not worth not buying the house for. It's nothing to be happy about, but sometimes they just exist. Closing times. Okay, sorry, number 5. Most of these DPA programs, because they're 100% finance, 100 plus, they at least want a home warranty for the first 12 months. It can be negotiated in the deal, seller paid, it can be buyer paid, it could be realtor paid. You know, it just has to exist and be enforced starting the day of closing. So where, you know, a typical FHA loan does not require or a conventional does not require a home warranty. These do. Closing costs or closing times. These could take an additional 10 to 14 days. This is probably where Cal Haffa, being one of the first and the oldest, got the most bad rap, because they do take an extra 2 weeks, because not only is the lender that you're using going through the file, but Cal Haffa is also going through the file. And unfortunately, while it makes sense that both of these people could be looking at the file at the same time, it doesn't work that way, because the lender sets up the file, prepares it, gives it to Cal Haffa. They either clear it or they make their own conditional requirements on top of what was already done, and then it gets bounced back and we deal with that. If they were just looking, if they were running parallel to save time, you could still end up with dual work, as well as one wanting one thing, one wanting another, who knows what. But the way it's going to work is they're going to wait to make sure that all the requirements are met. So that's why it potentially could take anywhere from 10 to 14 days. Most of the newer programs that are just FHA guidelines, they're closing in the traditional, 30 days. I've closed 3 this year in 30 days. The Cal Haffa Dream for All program, in that mad rush, actually closed 2 days early in a 45-day close, so closing 43 days. But be aware of that as a potential issue when you're writing your offer. No non-occupying co-borrowers, as I mentioned. So anybody on the loan that we need their money to purchase the home, they are required to live in the home for up to 12 months. Number 8, could be harder to find a property, mainly because you might be limited on purchasing strength. Might be harder to get the offer accepted. Number 9, because you are using these programs, you might need to add in a additional time for your escrow. Just makes it a little bit harder. And number 10, limited number of lenders offer these. Even some of the lenders, the LOs that have joined us over the last couple of years, they've came to us and they've never done these loans. And in a let's say normal market, these aren't used all that much, especially when you start to really do the numbers. And if your client has money, that the free money or the silent second isn't always a benefit, because a lot of times there is a rate hike. But we are versed in down payment assistance very well. Several of the lenders that work at Tried and True have closed these successfully. I love these programs. I think it's great. Even before coming here, one of my most favorite success stories was a guy that he looked for properties for over a year and a half. In that time, he started looking for a place for his family. In the middle of it, they separated, and he started looking for a place by himself, but close to where his potential ex-wife might live, and the kids to stay close to where they were at, because they were going to end up staying in the area they were at. And then he slowly changed over time, moving up north into like Marietta, Riverside area, to get a little bit bigger house for the income that he had. It took a long time. He ended up using a down payment assistance program. I think a year and a half after purchase, we refied him out of that, paying off. I believe he had, when we started the process of the refi, he would have had to pay 1 year's worth of the down payment assistance loan. So they each year they take a big chunk of it off. So if the loan is 15 grand each year of living in the property, he was working the grant program. So each year they would take off 5 grand. When he came to me, initially, he would have had to pay that 5 grand back. So we waited 3 months until that cleared. And then we refied him, got him out, dropped his rate by almost 2 points at that point. Then a year later, he did another refi, paying off his solar that he had added, paying off the pool that he had added, and took about 40 grand in cash, getting his rate into a mid-3 from 4.5%. So, this guy, he's right now, he's kind of, essentially, he's unfortunately cash poor because home prices where he's lived have gone up so fast because of COVID and everything that's happened. But his income, although it's increased, it hasn't increased to even compete. He couldn't even buy his own house again right now because of the value that it's at. And while the true problem with that is he's still working, there's an extra 150 grand above in home value and equity that he can never touch, really, because his financial situation only lets him play in this range around that 450 to 500 versus, using up to that kind of 700, which can be a challenge for a lot of people right now, and is also a reason why for him, he's probably not going to sell for a long time. And if he does, it'll be most likely for him, it's going to be moving out of state because, and this is, ideally, this is a reason why we have so few listings right now. It's part of the problem is, home prices went up faster than values or faster than income. And now, a lot of people can't sell their house. They can sell their house, but even taking the whole profit, they're not putting it into a house that they can afford that's better than the one they already live in. So they just stay. So it's a huge challenge. But these negatives, in my opinion, they're not that big of a deal if it allows you to stop paying, we'll use the number I use, $2,200 in rent that's just going out forever, and start owning and building equity and taking the financial tax breaks for owning a house and being able to do what you want with your own house and, being able to sell it years later with equity, having that. There's so many benefits to owning. If we're just looking at cash going out right now, absolutely. But here's the thing that I think that we'll end this with my rant and about prices. I do not believe prices in California will ever be lower than they are today, other than some very short moments in time in the next, I'll say 24 months. If you buy a house today for 600 grand, in the next 24 months, I believe there could be a month or two where they might drop slightly below that 600 value based on what's happening. But they will bounce right back up to where they should be or higher. And they will keep growing up. So that means to me, now is always potentially the lowest time to buy. And looking at just California, you cannot show me a place, an area where home prices dropped and stayed low. They just don't, Additionally, if these current 8% rates, if maybe they are the lowest we'll ever see, we don't know. But if they do drop and you own a home, you potentially have the option to refi. And if you can't refi at that point because of whatever's going on with your financial situation, that also means you couldn't have bought a house at that time as well. So that's not a reason to not buy, because if you can't refi, you certainly can't purchase if you didn't have anything. That's just the math, the way it works, because it's much easier to do a refi on a home you own financially, the requirements, than it is to purchase a brand new home, even at the exact same value. That's it for me. If there are specific questions for me, you can always send me an email. You can call me. You can message me through any of the posts that I have on site. I will put in, let's see real quick. Here's my phone number. Here is my email in the chat.
Yep, and I think if you were on last week's webinar, you saw that we did a little graph about home values from now, well, about this time last year into about February. And, you know, based on that graph, most areas of California, we did see a decline in value from about 5 to 10% during that time, which was this season right now. That's when we had a lot of DPA, you know, clients asking about things, and, you know, the competition wasn't as bad and stuff like that. So it was a good time for a lot of them to get into the home. And yes, it did stay flat. Maybe they saw a slight dip right after purchasing, if they purchased around this time through the end of the year last year. But by what? I think it was March or April or something.
I think
It
February is
had
when we
already
started seeing
swung back
decline.
up, and then they gained an extra 2% off of, you know, where they bought. So or where the last peak left off from the previous year. So even though there was the slight dip, they did end up coming out ahead still, and probably continued to be ahead. So, you know, this time of year, it's a good time to have these conversations, you know, with some of the ones that are sitting on the fence, like, hey, we can probably get you seller concessions, you know, let's work on that. We can do these down payment assistance programs. There might be some deals out there to be had. So, and you'll be in that position, like Andrew's friend, to refi when that time comes around.
Yeah.
Could be a year, could be 2 years. I would not be quoting people 6 months. I think the rates are going to be high for longer. They have continually moved that goalpost back a little bit. We can talk about that next week, actually, some projections of where the rates are going to be, some revised projections. I just have a nice graphic that I came across today that I can share. But yeah, have those conversations and see what you can drum up for some of these home buyers that are like, I would love to buy, but I don't have the down payment.
Thanks for staying on. I can't believe the number of people that stayed on for the whole hour.
Yeah, a little bit over, actually. Yeah,
I'm just like
appreciate
blah,
it.
blah, blah, blah. All right. Thanks, guys. See you next
All
week.
right,
Bye.
we'll see you guys. Have a good week.